So this is the take-up of the lease questions we didn't get to in class, and the first of the two that we didn't get to is P20.3 Hunter. So, pardon me, on January 1st, 2027, Hunter enters into an agreement to lease a truck from Situ. Both Hunter and Situ use IFRS, and then they give us the details of the agreement. Whenever you see red, that means like red font, that means that this is something I've added to the question just for me to make it clearer. So that's why I've added the fair value of the truck, the residual value guaranteed by Hunter, and the amount Hunter expects to pay under the GRV. So that's the additional information that I added. And then the additional information that the question has is here. Details, this is related to lessor accounting, so we don't have to worry about it too much. This is also related to lessor accounting, don't have to worry about it too much. All right. Discuss the nature of the lease for Hunter, the lessee. Since we set up here, Hunter uses IFRS and Situ, but that doesn't really matter because we're not doing lessor. For IFRS, you first need to prove that it is indeed a lease, and that means, do we have the right to control the use of an identified asset? This is met. Hunter controls truck. Which is the leased asset. Hunter's going to decide who can drive that truck, where the truck should be driven. Like the lessor doesn't really have anything to do with those decisions. For a period of time met, the lease term is 3 years. And in exchange for consideration met, Hunter pays $620 per month, including exec costs. So all three are met. Does the contract qualify as a lease? Yes. Does it qualify for the recognition exemptions? And the two exemptions are related to the length of the lease term. And no, the lease term is greater than 12 months, so that's not a way to get an exemption. And is the asset leased of low value? No, it's a truck. It's not basically similar to the value of a laptop when new, so no. That means we're going to do, therefore, regular IFRS lease accounting, which is the right of use accounting, which is basically equivalent to capital lease accounting under ASPE. Okay, so first question, prepare the journal entries that Hunter would make on January 1st, 2027 and 2028. So let's do that. We're going to first need to present value the monthly lease payments. Now, this one, the lease payments are monthly over 3 years. So that's actually 36 periods. And the interest rate is 12%. So we divide that by 12 months. So it's 1% per month. Unfortunately, this is not in the present value table. I had to do it in Excel. On the exam, I won't give you anything that isn't in the tables. But I guess you just have to believe me that the factor is $30.40858. Lease payment, $600. That's because we have to deduct the executory costs. So $620 per month, including executory costs. Don't forget, executory costs included in rental payments each month for insurance is $20. So I'm deducting that. That's how I got to my $600 a month lease payment, which is the portion of the payment that is specifically related to the financing. Multiply the two together, and I've got $18,245. That's the present value of the monthly lease payments, but we have a guaranteed residual value, a GRV. So this is the other component of the payment. Under IFRS, we need to capitalize the amount Hunter expects to pay under the GRV. They expect to pay $3,500. In other words, they expect that their fair value will actually be $1,500. They're guaranteeing $5,000. So the amount that they expect to actually pay out is $3,500. Under IFRS, it's the $3,500 that we capitalize. Under ASPE, it's the whole $5,000 regardless of what we expect to pay out. So the present value factor, this is again for 36 periods at 1%, but this is the lump sum factor because it's not an annuity like the monthly payments. It's a one-time payment of $3,500 at the end of the 36-month period. So that factor, again, Excel calc. I guess I could just say up here, this is an annuity due factor. The lump sum factor is 0.68989 for a total, I'm going to multiply these, of $2,446. Total present value of the minimum lease payments, $20,691. Okay. We could set up a lease amortization schedule. So we would start with our opening value of the lease obligation, $20,691, and then our interest expense at 1%, very easy to calculate. We have nothing on the first day of the lease because on January 1st, 2027, no time has passed. So our entire $600 lease payment goes against the principal here. So the net change in the lease obligation is $600, a decrease of $600, leaving us with an ending value of $20,091 as of January 1st, 2027. Now, coming into February 1st, 2027, we're starting off at $20,091. This time we do have interest because the month of January has passed. So we are going to incur interest at 1%. 1% of that is $201. Lease payment remains $600, which means $399 of the lease payment is allocated to reduce the principal or the obligation amount, bringing us down to $19,692, and so on. 1% of that is $197. Take the $197 from $600. $403 is actually paid in principal as part of your March 1st payment. So as of March 1st, we're sitting at $19,289. So let's do the journal entries. First, to record the acquisition of the leased asset. I'm going to debit the right of use obligation. The right of use asset. For the $20,691. And I'm going to credit the right of use obligation for $20,691. Also, on that same day, we have to record the first lease payment. So I know I'm going to be sending out cash of $620. 20 of that goes to executory costs, which they described as insurance costs. I'm just going to call it exec. If you call it insurance, that would be fine too. It's just an expense. And the other debit goes entirely to the right of use obligation because no time has passed, no interest has been incurred. So that's the 600. Basically, it's that line turned into a journal entry. Okay. For December 31st, 2027, to set us up for January 1st, 2028. On December 31st, 2027, in order to figure out, we would have to accrue interest, right? Because as of December 31st, the month of December's interest has been incurred but has not been paid, since they pay every month on the first of the month. So I need to accrue interest. So I'm going to debit interest expense. And the amount is $155. I haven't calculated that amount above. I would have to continue this table here for April, May, June, July, August, September, October, November, December in order to get this to work. So just trust me that if we continued the table all those months, then the interest expense that we would calculate for the month of December is $155. So I'm going to credit interest payable. Would need to continue amortization table above. So this is just a number that you're going to trust me on, that it's 155. The other thing that we would do as of December 31st, 2027 is we'd record the depreciation expense. I mean, assuming we just do this annually for simplicity. We have our $20,691, the leased asset value, divided by 3 years. Doesn't really say years. Let me fix that. 3-year lease term. Works out to $6,897. Okay. So now we're ready for the January 1st, 2028 lease payment. To record lease payment. First, we're going to reverse the interest payable that we set up the day before on December 31st of 2027. So this 155 comes down and is reversed the next day. It was just set up as an accrual at the month end. Of course, we have to debit our exec costs every single month because they're included in our $620 monthly lease payment. So let me actually show that monthly lease payment, a cash payout of $620. So whatever it takes to force the debit side to match the credit side, that's the amount that goes against our right of use obligation, which is 445. Okay, this is the force. All right, let's keep going. Identify all accounts that will be reported by Hunter on its comparative statement of financial position. At December 28 and 2027, and comparative income statements. I've only shown the income statement because I just want to be clear about what is going to show up here, and I've only done it for 2027. You'd give me a good title, excuse me, and then you would have 3 accounts that hit the income statement, right? Depreciation expense, executory costs. We know they are $20 per month. So that's going to be $240. Our depreciation expense is $68.97. And interest expense is the other one you will see. Now, again, we would need to do the whole table. Just going to go back. We would need to do this table for each month of the year, this table right here. And then we would sum them all up. And that sum, if I include the ... adds up to $2,139. So I didn't show all the lines of the table, so again, you're just going to have to trust me here that it comes out to 2139. Okay, so all of that really is pretty much review. It's this next part that I really wanted to show you. Prepare the journal entry for Hunter's payment on December 31st, 2029 to situ to settle the GRV deficiency. Because, just going back to the question, at the end of the lease term, right here, Situ sold the truck to a third party for $1,200, which was the truck's fair value. Hunter paid Situ the difference between the residual value guarantee and the proceeds obtained on the resale. Therefore, they must have paid They promised to pay $5,000, but the truck itself was worth $1,200, or they guaranteed $5,000. The truck was worth $1,200, so they had to pay $3,800 in cash. Originally, they estimated that they would need to pay $3,500. Okay, their estimate wasn't perfect. It wasn't too bad, only off by $300. But let's figure out how we deal with that. So, which lease-related accounts need to be cleared from the lessee's books? Well, since the lease is over as of December 31st, 2029, and they're settling the GRV, what needs to come off is both the ROU asset, because it won't exist anymore, and the ROU obligation. I just produced here the last 2 rows of the 36 row lease obligation amortization table. The one that we started on the other page back up here. This is the first 3 rows, and this would be the last 2 rows. Because remember, they expected to make a lease payment of $3,500. That was the amount that Hunter estimated it would have to pay at the end of the lease. The right of use asset. Well, the carrying value of the leased truck asset on December 31st, 29, that's going to be 0, right? Because we will have been depreciating it. Depreciating asset over 3 years. So the carrying value is 0, but we do need to get the ROU asset and the accumulated depreciation off. So those are the two things we're going to do. Let's first deal with the lease obligation. To settle lease obligation. Our last payment of $3,500 actually includes, as you can see, a little bit of interest. Just going from the table, right? Interest expense of $35 on the $3,500. We're going to debit our right of use obligation for $34.65. Again, just going by the table. And we're going to credit cash. As we already calculated, we needed to pay the lessor $3,800 under the GRV, the guaranteed residual value. That's a little bit higher than what we expected to pay, so I need another debit of $300. And that debit is loss. We had a loss on our GRV. Our estimate was slightly off. Not hugely off, but it was off. So we recognize a loss at the end of it. And then as far as the asset goes, we're just going to de-recognize the asset. So we're going to debit accumulated depreciation for $20,691 because the thing would be fully depreciated by now. And we're going to credit the right of use asset. And that's it. We did do the next question. We did that in class together. The last quick question I want to do is 2013, Jamie Delory and Yogendran. So this is a second lease payment calculation question. I like this question because it's like a complicated lease payment question. So Yogendran, which is basically the car dealer, this is under ACCT, leases a car to Jamie Delory on June 1st, 2027. The term of the lease is 48 months. The lessee is given an option to purchase the automobile at the end of the lease term for $5,000. So we have a purchase option. I mean, the question is it a bargain? We don't know yet. Let's keep reading. The automobile's fair value on June 1st, 2027 is $29,500, carried in Yogendran's inventory at $21,200. Okay, so that's fine. Yogendran's going to make a profit on selling this car, but that's a lessor issue, so we don't need to worry about that. The car has an economic life of 7 years with a $1,000 residual value at the end of that time. The car's estimated fair value is $10,000 after 4 years, $7,000 after 5, and $2,500 after 6 years. Why are they telling you this? Because this is the information that you can use to determine whether that's a bargain purchase option. The term of the lease is 48 months. That's 4 years. Therefore, Jamie Delory can purchase the car for $5,000 at the end of 4 years when the car's estimated fair value is $10,000. Is that a bargain purchase option? Yes. Which means we can assume they will pay that $5,000 as part of the lease, because it would just make sense. Buy the car for $5,000, its fair value is 10, maybe you can sell it for 9. You're not going to just not take that 4,000 gain. Maybe you can sell it for 10, which would be great. You can get the full 5,000 difference. Okay, Yogendran wants to earn a 12% rate of return or 1% per month. We're going to have to use the monthly rates on this. Jamie DeLaurie represents a reasonable credit risk. Again, this is a lessor issue, which we don't need to worry about. And the lease agreement calls for a $1,000 down payment and 48 equal monthly payments. So, if we're determining as the lessor what would be the amount of the monthly lease payment, so the lessor would set the payment, but as the lessee, we want to also calculate it. So what we're going to do is, there are 3 payments here, 3 different types of payments that Jamie DeLaurie will make, right? The first one is the down payment for $1,000. The second is the monthly lease payments. That's what we're trying to solve for. And the third is the BPO payment. We can be reasonably certain that he's going to pay the $5,000 at the end to get the car. The way we deal with these 3 elements is as follows when we're trying to solve for X here. First of all, the lessor wants to recover the fair value of the car, the $29,500, through these 3 different payment types. First, the down payment of $1,000, that's paid up front. So we can just deduct that right off the top. So, therefore, Yogendran wants to recover $28,500 net of the down payment through lease and the BPO payment. Let's now deduct off the BPO payment because we know the amount. So the BPO price, BPO price is $5,000. The lump sum factor, we're going to use 48 periods at 1% per month. The factor is 0.62026. Again, I had to get that from Excel because the table doesn't have a column for 1%. So just trust me on this. If you multiply that out, we're going to deduct off 3101. The present value of that $5,000 payment 4 years out, bringing it back to today, is 3101, which means through the monthly lease payments, the 48 monthly lease payments, we need to recover $25,399. And to do that, we're finally ready to just divide by the annuity due present value factor for 48 periods at 1%. So I'm going to take my $25,399 divided by the factor, which works out to be 38.3537, and monthly payment $662.23 per month. And that's it.